Last week, GE Aerospace reported one of the strongest quarters it's posted since spinning off from GE in 2024. Revenue up 29%, orders up 87%, earnings per share up 25%, free cash flow up 14%. The company raised its full quarter profit outlook, and when markets opened the next morning, the stock dropped roughly 5%. That reaction is worth understanding, not because the market was wrong, exactly, but because the reason most outlets gave for the sell-off doesn't capture what's actually happening inside this business. The conversation focused on margin compression and geopolitical uncertainty. Both of those things are real, but they are the surface. Underneath them is a structural story about global aviation supply that is genuinely significant, and almost nobody led with it. That's what this story is about. First, let's establish what the quarter actually looked like, because the numbers were not ambiguous. Commercial engine services revenue was up 39%, with total engine deliveries up 43% year over year. Orders across the business nearly doubled on the commercial side, and defense side orders hit their highest level this decade. Internal shop visit revenue jumped 35%, and spare parts revenue grew over 25%, supported by a $170 billion commercial services backlog. GE Aerospace's total backlog now stands at over $210 billion. That number represents committed future revenue, engines already sold, service contracts already signed, maintenance agreements already in place. It's not a projection, it's in the books. So what spooked investors? Two things. First, operating margins came in 200 basis points below last year's, meaning GE is growing revenue faster than it's growing profit right now. Second, GE cut its full-year global departures outlook from mid-single-digit to low-single-digit growth, primarily due to the ongoing conflict in the Middle East. We'll come back to both of those later. But first, the story that should have dominated the coverage and didn't. There's a term GE management used on the earnings call that most financial reporters overlooked: spare parts delinquency. In aviation, delinquency refers to parts orders that were supposed to ship and didn't, because the manufacturer couldn't produce them fast enough to meet demand. It's a measure of how badly supply is lagging behind what airlines actually need. GE Aerospace's spare parts delinquency is up roughly 70% since the end of 2024. Let that number sit for a second. In a year and a half, the backlog of overdue parts has nearly doubled. Spare part orders were up more than 30% year over year, and management explicitly said demand continues to exceed supply, even as GE has grown revenue by more than 25% for 5 consecutive quarters. Think about what that means though. GE is producing more jet engine parts than it ever has. Airlines are ordering even faster. Gap isn't closing, it's widening. As a result, GE is entering the second quarter with more than 95% of spare parts revenue already committed and in the backlog. That's extraordinary for a manufacturer. It also means that if something were to disrupt the output, like a supplier bottleneck, a quality issue, a logistics problem, there's almost no slack in the system. This is not a story of a struggling company. It's a story of a company that cannot make its products fast enough to satisfy customers. That's a good problem in some ways, but it has real downstream consequences for airlines. And one of those consequences is starting to take shape right now. So let's talk about the turbine disk problem. This detail didn't make it into most of the earnings coverage, but it did surface in specialized aviation press, and it's worth understanding. Southwest Airlines, among other carriers, is facing a potential shortage tied to life limits on high-pressure turbine disks in narrow-body engines that are capped at 10,000 flight cycles, with more than 40 aircraft approaching the 8,000 cycle mark. Replacement hardware with higher durability was not expected to be available in meaningful volumes until the second half of 2026, creating a near-term supply gap. High-pressure turbine disks are among the most stress-intensive parts in a jet engine. They spin tens of thousands of times per minute in extreme heat. When they reach their certified life limit, they have to be replaced. No exceptions. Without sufficient spare engines or replacement hardware, airlines can be forced to ground aircraft or adjust schedules, particularly during peak summer travel periods. This hasn't shown up in GE financial results yet, but it's the kind of operational bottleneck that tends to become someone's headline in July when summer travel demand peaks and airlines start juggling their fleets. GE is working to resolve it, and replacement hardware is coming, but the timing is tight. Now to the thing that actually moved the stock. The Iran conflict and its effect on air traffic. In the first quarter, global departures were up low single digits overall, but the Middle East specifically saw a high single-digit decline, a region that represents roughly 5% of GE's total departure base. For the full year, GE now expects a low double-digit decline in the Middle East departures, with modest reductions to other regions as well. So why does this matter for GE specifically? Because GE Aerospace's services business, like maintenance, repairs, spare parts, is tied directly to how much engines fly. Fewer departures means engines accumulate cycles more slowly, which means shop visits get pushed out, which means near-term services revenue is softer than it would otherwise be. Management acknowledged that if not for the current geopolitical environment, they likely would have raised full-year guidance. That's a meaningful admission. The business, left to its own fundamentals, is running ahead of expectations. The macro environment is the limiting factor right now, not the operations as it pertains to the service side of the business. Here's the thing about a $211 billion backlog that's easy to underappreciate. It's not just a big number. It represents structural demand that exists almost regardless of what the next few quarters look like. In Q1 alone, GE announced commercial wins for more than 650 engines, including agreements with American Airlines for more than 300 LEAP 1A engines, United Airlines for 300 GE&X engines, and Delta Airlines for 60 GE&X engines. These are long-term service agreements tied to aircraft that will fly for decades. And full-year services revenue growth guidance was raised to roughly $4 billion, up from a prior estimate of $3.5 billion. GE is also investing $1 billion in U.S. manufacturing sites and supplier capacity for the second consecutive year, with an additional $100 million directed specifically to external suppliers for equipment and tooling. A direct acknowledgement that the supply constraint is real and requires capital to solve. So what's the actual takeaway here? GE Aerospace is a company where demand is so strong it can't keep up. The stock sold off because of margin compression and geopolitical caution, both legitimate concerns, but the structural picture is of a business sitting on $211 billion in committed future revenue, with orders running nearly double what they were a year ago, investing aggressively to expand the capacity that's currently the only thing limiting its growth. The supply crisis in aviation isn't going away. Jet engines are complex, expensive, long lead time products. And every day that more aircraft fly, more parts wear out. GE is the center of that equation. And right now, they can't build fast enough. That's not a bad place to be. It's just a complicated one. This has been Insight to Invest, the channel that gives you insight into a company and you decide how to invest to grow your money. Watch some of these videos that YouTube thinks you'll like. I'll see you in the next one.